With the memory of the last downturn still fresh in our minds, many investors remain cautious with their investment portfolios and feel comfortable holding very safe, low-yielding bonds, high-quality traditional bonds. Can you speak, though, to the risks that these bond investors will see if we have a period where we do see rising inflation, rising interest rates, and what can an investor do to their bond portfolio, or what we consider their safe part of their portfolio, to offset some of those risks that we might see in some of what we consider today to be pretty conservative or safe bond or fixed income investments?
Well, I think at least over the last week or so, the high quality trade, the flight to quality trade that we saw back in 07 and 08, the move from more risky securities into treasuries is working again because of some place called Greece and some of the sovereign risk that we're seeing in the marketplace. So people are again fleeing to quality, and that's certainly helping the U.S. markets, particularly the treasury market. When I look at the fixed income markets specifically at this point, obviously the primary risk that we're all worried about is rising interest rates, because we know that as rates rise, the prices of our bonds are going to come down. So that's a real key interest of a lot of our clients. Obviously, the other thing we're worried about is just what's happening to the quality, the credit quality, so to speak, of our portfolios. Not only corporate bonds, whether they be investment grade or high yield, but municipals. Think about some of the problems we're having in state and local governments. So credit quality is an issue that we're worried about as a second risk. But maybe to me, and I was thinking about this over the last couple of weeks as I addressed senior management of our investment committee, and we're asking the same question of our portfolio managers and how we're going to prepare for this, both with our portfolios and mentally be prepared from a macro and micro perspective. But to me, maybe the more important risk in this cycle isn't so much rising interest rates or when the Fed leaves and takes their liquidity and rates start to rise or credit quality. It's, when do we see asset prices moving past fundamental valuations and move to more speculation? And when's the next bubble being created? And to me, that's a key risk, I think, that we're looking at right now. So to me, the way I think about that is I think you need to position your portfolios around some key areas and attributes. Whether you're talking to your advisor or portfolio manager, I think obviously you want to try to minimize that market risk, that interest rate risk. And the typical response is go to short maturity bonds, go to short duration bonds, move into the front of the yield curve. And in some market environments, if the yield curve is flat, where short rates are kind of equal to long rates, that may not be a bad strategy. But if you look at today's environment, we're in a very steep yield curve where short rates are almost at zero, in many cases are, and long rates, the 10-year Treasury is about 240 basis points or 2.4 percentage points higher. So in that type of environment, to move to the short asset, the short maturity asset, might not be the right thing to do. Because when rates do begin to increase, where are they going to increase first and who's going to increase rates? It's going to be the Federal Reserve, and that part of your portfolio is going to increase in rates pretty quickly. And you will not have time, in my opinion, to react all that quickly yourself, because we're just not that smart. We won't even do it, and we're professional investors. So in this environment, I think to minimize market risk, I think an intermediate type duration or maturity, bond maturity in that maybe 4 to 7 year type area might be a better place to be. We're finding a lot more value in that intermediate part of the yield curve. The other thing I think you need to do is seek strategies that maintain a yield advantage. If you have a yield advantage in your portfolio based on the securities you're buying, and that's relative to your risk preference, that yield advantage over a treasury, let's say, by investing through corporate bonds, for example, or agency bonds where you're getting some spread in interest rates over the risk-free asset, which is a treasury, that gives you a cushion against interest rate rises. And that gives you carry against that interest rate rise, and that cushions interest rates rising. So you want to kind of have that yield advantage, again, relative to your risk preference. So you want to maintain that. I think diversification is also very key. I know diversification didn't work in '07 and '08. Everything correlated to one, and we all read articles about diversification not working, but believe me, it does from a long-term perspective. And I think you diversify not only in the types of securities you're buying, but some of the strategies. You want to also diversify your maturity points in your portfolio. And last but not least, I think you want to maximize specific risk inside your portfolio. Right now, if you ask me what is the best strategy from a fixed income standpoint is using a manager that I like to call bond picker, a manager who's going to give you what we call bottom-up investing. And by bottom-up investing, I mean you're talking to a manager that delivers most of your return in your fixed income portfolio through good security selection. And that means we can buy securities, and investors should be able to buy securities across any market cycle. So you should look at managing those risks with specific securities. So to me, I think you invest opportunistically right now, diversified. I think you focus on long-term performance, not short-term. I think you focus on kind of a more intermediate duration portfolio, maturity portfolio. Now, when rates go up and the front end goes up, maybe you move some of your money down there. You consider strategies like bond ladders, where you have an opportunity to reinvest as rates go up and money's coming due. So I think it's those types of things, those attributes that will help you with a fixed income portfolio to manage that interest rate risk, that credit risk, and maybe more importantly, going from fundamentals to speculation, because believe me, fixed income valuations have come in quite a bit. The market's a bit top heavy. Valuations are extreme again in some cases. And I think these types of manias, these bubbles, are going to be more frequent in our lives, and periods of volatility are going to be more frequent. So a little more active discussion around those four elements, I think, is very key.